portfolio manager of TvH Wealth, Denis Bazan. Denis, welcome, and how are you today?
We're better. We're actually starting to see a little sun now. Don't know how long it's going to last. We had our rain in the morning, so hopefully it's finished.
Well, send the sun my way. So we're going to attempt to do something today that we've never been able to do in the history of this podcast, which is we're going to try to keep this one under 30 minutes and maybe even 20 minutes. All right, we're going to do our best. But today we're going to talk about active versus passive investing and really what's the ideal or ideal way to invest. And we've talked about passive and active, but we've never really, I don't think, explained the difference between the two methods are. So we're going to go through that with you today, and we're going to get into a little bit or dive a little deeper into what is passive investing and what is active investing. And there's definitely two schools of thoughts. You normally have people on one side or the other, and we might throw a little bit of a twist in there in terms of how Raintree Wealth Management manages their portfolios and what strategy that they use. So that is us in terms of what we're going to be talking about today. And I think, Denis, we're probably going to rely a lot on you being the portfolio manager and the level of experience that you have. Ryan, anything you want to add before we kind of dig deeper into the difference between passive and active?
I think often we explain things to clients. We want to educate clients when it comes to any of these things. But I think it was great for us to have this conversation a little bit more in depth, because what happens is sometimes you only retain 10% of the information that we talk about with clients. And when it came to passive and active, obviously we chatted about it the last couple of days. It was important for people to have a further understanding and finding what's right for them during kind of the exploration of diversification of their portfolio, what it means to be active and passive, having a blend of both perhaps. And again, we do this podcast for education purposes, and obviously for those watching, want to see our beautiful faces too. So
and you know what, and I'm definitely not a fan of ever really saying one is absolutely better than the other in any recommendations that we make. I think every type of financial instrument, every strategy has its place in people's retirement plan. So we're not here to say one is better than the other. We're just here to explain the difference between the two. And then ultimately, you're going to decide as the investor what makes sense for you. So why don't we get into passive investing? Denis, what does passive investing really mean to the layperson?
Well, really what you're doing when you investing in passive investments is you're buying an index fund. These funds are low cost, easy to buy. They usually come in an ETF as how people use it. Easy to buy on an exchange. They match the benchmark. So really, if you're going to buy an S&P 500 fund that was just started yesterday, you can still check the performance. You just check the S&P 500 return. So you know what you're going to get. Some of these indices are very visible. The only difference between the benchmark itself, like the TSX or S&P 500, is a small management fee or admin fee on the ETF. And you may get a little bit of tracking error, but that's sometimes, 1 or 2 basis points. That's not going to make a difference. So you're getting, you know what you're getting. They've been a little more volatile in the last few years, but at least you're getting the performance. You want, exposure to NVIDIA. You're going to get in the S&P 500. You just buy that instead of the stock. So very easy to buy.
Can you maybe dig a little bit deeper for people who don't quite understand investing? What's an index?
Well, index is basically, we'll take the example of the 500 because that's more known, even more than the TSX. That's changed in the last few years a few times. It's just 500 stocks. They're weighted according to their capitalization, and it basically tells you all of them together whether the U.S. market, for instance, went up or down based on all the activity and what happened in those stocks. So
Right.
in this case, when you're thinking about buying it, you just want exposure to the U.S. market. You don't want active management. That's the fee's going to be much higher. You just go out and buy a index fund. That's the same with the TSX. You don't want an active manager. Maybe they're buying too much oil or something, or not enough oil, and you want gold and exposure of everything. An index fund. You're going to get the full exposure of all of it. There's pros and cons a little bit, but for the most part, it's that easy, and it's really people that want exposure in a certain area.
Mhm. I think some of the things that people want to consider especially when it comes to passive, is like often I've found so far is that there's a lack of flexibility within them because of the way they're built. Um, and then obviously, when you look at most mutual funds or ETFs, they're kind of built similarly for a lot of institutions. You look at and we've talked about this before, we look at the ETFs, we look at certain stocks, and they're always kind of picking the same things that are often repetitive. So again, we talk about diversification. What does that actually mean? What does it mean to be diverse? Oh, whether you're in a mutual fund that is high or medium or low risk, they're all still kind of invested in the same thing. So it's things to consider when it comes to the passive market. And at least in my experience too, and you kind of touched upon it, Denis, which is it's not being actively managed, hence passive.
Yeah, you brought up a good point. What we have sometimes is active managers that charge a higher fee, but they call them closet indexers.
Mhm.
They really do very similar to what the index does, partly because they're paid on their performance versus the index, but they're closet indexers and you're paying high fees basically for nothing. So when you're looking at
Yeah.
active managers, you got to be careful on buying somebody that manages in that way, because you're much better off in just a index fund ETF and sticking to passive investment if you're going to get somebody like that.
So
So I guess
when somebody,
someone gets into passive investment, it's to save money, ideally, right? It's a low cost solution. It is just following an index, and I think we've talked about this in a recent episode, where if you were an investor who went to one of the robo platforms, because I think robo platforms typically use ETFs or passive style investment. If you just contribute whatever you contribute every single year, you leave it alone. You don't look at what's happening in the economy. You don't look at what's happening in the marketplace. You don't look at your account balances or your statements, and you leave it there for 20, 30 years. And finally, you decide to open it up when you're set to use the funds, let's say for retirement. You probably have done well. The problem with passive investments, so there's positives, again, low cost. The challenge with passive investing is that most people don't invest that way. And now we have to kind of take into account behavioral finance. And what does that really mean? And that's one thing that we can't measure is behavior. And I think that's really the biggest challenge with if you just go all in on passive investment. If you're a sophisticated investor, you're someone in the industry, you know how it works, you're probably going to be just fine. However, most people don't behave that way. They react to what's happening out there in the marketplace. And I think that's really one of the biggest challenges of just strictly going with passive investments is how are you going to behave when things go bad? Right? Would you agree with that, Denis?
Yeah, for sure. Because in passive investing, there's no active manager to maybe minimize the volatility. Whether you're potentially in the TSX, where it's a heavy, and has been much higher, but a heavy weight in energy, depending on what oil does, that could really affect the returns. The same with the S&P 500 on technology. If AI suddenly turns, that index is going to get hit hard, and you will not be able to hide because you don't have a manager selling off or taking profits or anything like that within your passive return index fund. So that's key, and that's a little the pros and cons. When the market's up, passive or active, everybody's happy because everything's going up. It's when you get the volatility, uh, that's when people start questioning it, and they say, oh, that's when they're going to start reacting to big swings in the market.
Yeah, and I've noticed that over the years in the industry, and it's not quite looking at passive or comparing passive over active in this scenario, but I remember in the late '90s when the .com era was on fire, and people were buying all types of tech stocks, and the smart active managers were a little bit more resistant because they looked at valuations and things of that nature. And I remember people were buying all types of tech stocks, opening up self-directed accounts, basically saying, you know what, I don't need advice. Look at the returns. I can do this all myself. And then the crash happened. And that's when a lot of those self-directed investors kind of came back to working with advisors because they realized, you know what, not for me. I'm obviously not sophisticated enough to understand and make the right decisions. And we're kind of seeing that in the robo-advisory market. Again, there's a place for robo-advisors. There's no advice. So if you are someone who truly recognizes that you just set it and forget it, then that will work for you. But as I repeat, most people don't act that way. They say they will act, that they will set it and forget it when, to your point, Denis, the markets are performing well. And then we see major corrections and people are now retreating into GICs and daily interest savings accounts. Right? So let's move on. Go ahead.
Sorry, I was going to add to the behavioral side of the herd mentality, right? The behavior is that, when you're talking to your neighbor and they suddenly talk about, I'm getting X amount of percentage points on this. That's when, it starts crumbling. And I think going back to your point about, when the markets are up or the markets are down, I think it's just people's time. What it comes down to is their time. Denis, your life is evolved around, watching how the market's performing, right? We have neighbors that kind of look at the market or take whatever the CBC is saying about the market today, but that's often the CBC is reacting to something versus preparing for something that is potentially, again, we still don't have a crystal ball yet. It's still an Amazon backorder.
Supply chain issues.
Yeah, supply chain issues, exactly. So it's that herd mentality that often relies, and again, we look at the crash of the Depression, that's a herd mentality of rushing to the bank to pull your money from, which then caused an even bigger issue when it came to the banks, right? So I
think that was a little bit different though, Ryan, because banks were literally failing and people had I think the Great Depression maybe wasn't the right example because people were literally losing their money. Banks were failing and people lost all their money on deposit, right? I would say with a herd mentality, I'll use the tech bubble as an example. I don't know how many times, and at the time I used to play hockey and I would be in the change room and I would hear guys saying things like they were, refinancing their mortgage and they were going to dump $100,000 into Nortel. And I would just shake my head. I'm like, and why? It's because, well, their brother did it and made X amount off of it. And their neighbor did it and made X amount off of it, right? So they were definitely depending on the stage of the cycle with Nortel as the example, you either did really, really well. I'd say most people did poorly because they still kept hanging on even when things started to correct with that particular stock, right? Yeah. But the herd mentality is the big one because everyone talks about how many home runs Babe Ruth got. They don't talk about all the strikeouts, right? And whenever I hear people bragging about an investment, they don't talk about the losses because they're embarrassed by it as well, right? So you are correct about the herd mentality. We do have to worry about that. And that's where when we see these commercials on TV and they talk about, well, if you paid, if you didn't pay that 2% fee, you'd have X amount, 30 years from now or whatever else. The problem is they can't measure behavior. I think it's the one thing we keep talking about. And we do have an ebook that we've written about the psychology of money. and the tortoise versus hare strategy. So I encourage people to go on our website and download that ebook. But it does talk a lot about the psychology around money and making decisions and how people react to certain situations, right? So I think we need to move on to we've beaten up the passive side of things. What is active management, Denis?
Well, the active side's when you actually have somebody picking stocks. Say if you're investing in Canada, they're going to pick stocks. They're going to see what's out there, look at the profits, they're going to look at the economy, and they're going to find areas where to invest and what companies to invest in. Now, in a lot of cases, the TSX is probably an index easier to beat than the S&P 500 is. S&P 500 is a lot more difficult. Because depending on what sector is strong, if there's only one of them or one of them's outperforming and you're overweight compared to the index in that, you can outperform the TSX probably rather easily if you're going to make those calls. This year, it's like, especially with what's going on the tech side, the strongest, one of the strongest sectors in the TSX is energy. You don't really hear about that. And if you have a manager that stays away from resources and is constantly heavy in banks or financials, they're going to underperform. So what you want is an active manager, and sometimes they're not that easy to find. You want somebody who can make these calls on a regular basis. This goes for all the, all the other areas like the U.S. as well. Some U.S. managers just did not want to put that much risk in their portfolio by taking big bets on NVIDIA, Meta, and the rest of them, Amazon, and they were and have been and continue to underperform the S&P 500. Now, that's a case as a matter. Do you want that risk and take the returns, or do you not want that risk and go for it in case it crashes and then you won't be part of that fall? So there are benefits to both. Some areas you may want to have a passive, but some areas you do not want to have a passive, especially when it comes to different sectors of the market, like the small cap, the mid caps. Those, first of all, it's hard to find an index, both Canada and US, that could match it. And second of all, that's when an active manager could really add value by picking the right companies. We have that in our own portfolios. We may buy we did buy the S&P 500 ETF as a passive index. One, because we wanted that exposure, where our prior active manager, was not. So we wanted that exposure. But on the mid cap, the small cap side, we want active managers because they're the ones that can add value to the portfolio. And when you look at both of them, and you look at this even at the when you're going to shop to buy passive investments, the asset allocation itself is what's going to drive the performance. And that becomes active. You need an active asset allocation. You need to rebalance. You need to sell and take profits. You need to sell completely if you're buying something that's just not working out, where some people, and I think we'll get to the behavioral side, they just don't like selling losers. They want to think it's going to turn around, and they don't like selling winners because they think it's going to keep on going up. That's when you need this discipline as well as active, not only managers, but asset allocation to make decisions on both. I could get a little more into the portfolios, but I'll leave it for now. See if there's you guys want to add to it.
Well, I'd like to paint a picture and use an analogy here because I'm a big fan of trying to simplify things for people. Okay.
Go ahead, Bob Ross. Paint that
All right.
picture.
All right. We're going to be flying to Europe from Canada, and you want the lowest cost option available to you. Okay. So this is the passive investment. No human interaction from start to finish. So you order your vehicle service. It's an Uber, whatever it is, but it's an autonomous vehicle. Again, you don't want to have any human interaction because it just adds cost, right? And you're going to get in that car, and you're hoping that car is going to get you from your house to Toronto Pearson International Airport without any incident. Now, some people would say, that's cool. I can live with that. Other people are like, I don't know if I can trust an autonomous vehicle to just get me there. Then you get to the airport. So safely you get to the airport. self check-in. I've been doing that, and that's easy enough, and that works, and no human interaction. And I get all my stuff onto the plane. And then I get to the gate. There's no staff. It's just basically there's a bell that rings and it tells you when to board the plane. So then you board the plane, and you notice there's no air crew. There's a couple of little robots. They're going to be serving you the food and the drinks and whatever else during the flight. And in the cockpit, there's no human being. It's an autonomous plane. And you're going to rely on that plane getting you from Toronto Pearson International Airport to, let's say, Rome in Italy. Now, that's the lowest cost option available to you, right? Because there's no human interaction. You're hoping that the computers are going to work, that everything's just going to kind of get you there smoothly. We know there's turbulence. We know there's mechanical issues. We know there's things that happen. So I prefer to pay a little bit more to have a human get me to the airport. I don't mind the self check-in, but sometimes, you know what, things just don't work for whatever reason. So I do have to ask for a staff member to help me with the self check-in. I like being at the gate, knowing someone's actually checking security, making sure that no one's boarding anything that they shouldn't be boarding. And hey, I love seeing the pilots in the plane, you know, who are going to get me to my destination, because at the end of the day, there are situations that are going to happen, and you require experience, human interaction to get you through the turbulence, to get you through the storm, to get you through whatever they need to get you through. That's active investing. There's human interaction. They can react to situations based on experience. Are they 100% right every single time? Absolutely not. But the other side isn't either. And sometimes there are just things that happen on the autonomous side where without that human interaction, that plane's going down. You're not getting to the airport. There's issues, but it's the lowest cost option. So pick your adventure is basically what I say to people, right? Pick your adventure. You know, have some assurances that you know that there's someone there that you can speak with if you have a question, right? If you're wondering, is this abnormal, the turbulence that we're dealing with? You know, you can actually ask someone that question and they can let you know what, you know, give you their honest opinion. Or you can sit on a autonomous plane with all the turbulence and you can't call or ask anybody about what's happening because there's no one to call or ask, right? That's the difference between the two. Mm-hmm. How did I do with that one? I just thought of that this morning. Does that make sense?
It makes sense. And until we get to a point where Arnold Schwarzenegger comes up and says, "Come with me if you want to live," I don't think we're quite there yet. But I'm sure in the next 20 years it will be. But no, a pretty great example. So
cool. So, Denis, with TvH Wealth, working with Raintree Wealth Management, the portfolios do hold a combination of both. Mm-hmm. There is some passive and there is some active. Why don't you talk a little bit about that?
Yeah, we made the decision earlier this year with the new investment team to start looking at passive investments, benchmark ETF, where it's better suited. Don't forget it's a lower cost as us as well. If we're going to buy that instead of paying an active manager, we selected the TSX and the S&P 500. One, as I mentioned before on the S&P 500, we had an active U.S. manager. We're paying the higher fees, but the manager was making decisions to basically really minimize the tech exposure. So we were underperforming the S&P 500 index, our own benchmark, by quite a bit. So we decided to make a switch there. And we did the same thing with the TSX. Now, as I mentioned before on an active manager, you really got to find somebody that's going to be active and not stay away from any industries because whatever doesn't meet their ESG qualifications. We were looking at some managers on the TSX that were staying away from resources. As I mentioned before, that what's one of the top sectors so far this year on the TSX, it's energy. They had very little energy exposure. Now, the only way you're going to get that, along with the exposure you want in the banks, all in one, and make sure it's always like that, is to buy that passive investment. Now, we remained, as I mentioned before as well, we remained active managers on fixed income. Fixed income, if you're looking at a universe ETF, for instance, on fixed income, it's negative up until this day, even with the rate cut. Our managers have been active and they're on the positive by 2 or 3%. So they're outbeating their benchmark by quite a bit right now. So it's a matter, we wanted somebody to make a decision on, whether to buy corporate, whether to be long, whether to be short. That's when we feel we really need active investments. We did the same on the small cap funds and that mid cap level with a couple different managers. That's where you're adding, again, you're really adding value to the portfolios. Outside that, we invest in things, as most people know now, as alternatives, whether it's private credit, whether could be a little real estate, whether it's absolute managers. Those type of managers will have the returns irrespective of what the public markets are doing, or that's their goal. They have target returns on a private credit, say from 8 to 12%. That's their target. And when they lend out to companies on their variable loans, you're going to finish off that year, hopefully within that target. Not always going to hit the target. We had a couple that was above that last year, and we're going to have one that's a little below that, but you're getting that stability of returns. The same with the absolute managers that trade and want returns no matter what the market is doing. That's protecting on downside and while always getting a little of the upside. Their I was going to say correlation, but the way they manage compared to the market to stay away from those type of terms is they want returns no matter what these passive indexes are doing. So this really helps, and it really helps depending on the stage of your life. If you're starting to withdraw, you do not want to withdraw if the market's volatile and the fund's down. When the index is down 5, 10%. We've seen a lot of periods where in one day they could be down 3 or 4%. When you're withdrawn, you don't have the time horizon anymore to recover that because the money's already out, and you're going to continue to pull it out. So that's why on the full using passive and active together, I think gets you to the best solution.
So we're going to start closing this. Ryan, anything else you want to add to the conversation?
Talk to your advisor, talk to your portfolio manager, what makes the most sense for you, depending on where you are with your career, with life, what your goals are, which is the most important. That's why we put these out, is just constantly check in what your goals are. Because if you just, as you said in the beginning, if you just leave it, forget it for 20 years, it can do you well for a period of time, but in those times that you really need to make sure that, how tax efficient is this? Where am I being put into too much risk as I'm closing close to retirement, or another goal like buying a house, and really put you at a high risk. So again, making sure that you're talking to the right people, your trusted team. So
perfect. Well, I think we'd like to thank everyone for tuning in to the episode of the Money Mindset Mastery podcast. And we hope that today's discussion really helped clarify the active versus passive investing debate. And we're hoping to provide you some guidance towards making informed decisions for your financial future. Now, don't forget to subscribe, leave a review, and join us the next time for more insights into mastering your money mindset. If you have any questions or you're looking for personal advice, so if you don't have a portfolio manager to speak with or someone that you or a trusted advisor, reach out to us. You can reach out to us on our social media channels. You can come to our website. Our main website is tvhgroup.ca. You'll have access to TVH Financial. You have access to TVH Wealth through there as well. And remember, whether you choose to invest actively or passively, the key is to stay informed and to stay disciplined. Guys, once again, thank you very much. It looks like the internet stayed true for us this time around, thankfully. And have yourselves a wonderful afternoon. Until next time, we shall see everyone soon. Take care.